Thank you very much for attending the fourth breakout session, which is essentially looking at the tax office audits. What we're trying to do here essentially is to give you an insight into our experience with regard to tax audits across Europe. As Mike was saying earlier on this morning, we have 300 plus clients. As part of the routine of looking after those clients, we'll see audits all the time. So essentially what's happening is that we're seeing a theme and understanding that's going through. And what we'd like to do is just talk through the individual countries where we're seeing tax office activity. And then we're also going to be talking about the questions that the tax offices ask. And these are essentially the takeaways for you to go back to your office, talk to your colleagues, and basically see whether these questions you can answer successfully within your own organisations. If you can, perfect. If there's one or two you can't, then maybe there's areas to work on in the event of a potential audit that may take place in the future. The reason why we're looking at this is threefold, essentially. With the economy, European economy being in such turmoil, although thankfully it looks like we're coming out of it now, we're seeing that tax authorities are looking to generate revenue. They can do so in one of three ways. They can raise taxes through increased rates or introducing new taxes. They can close perceived loopholes or stricter enforcement. And it's that stricter enforcement here that we're going to be looking at with regard to the next 30, 45 minutes or so.
We decided to implement a sort of traffic light system throughout Europe to give an impression of the eagle-eye view that we have over our 300 clients and the 28 European member states, and how in a red territory the tax authority is potentially raising more audits, more questions, enforcing the taxes more strictly. To the green countries, which are more passive, maybe not asking as many questions and sort of leaving the insurance companies, policyholders alone. And then amber somewhere in between.
What would be very useful is if you have your own experiences with regard to tax authorities, if you like to share, and we can compare those with our experiences. It's always very useful to know what other people are going through. And please do ask questions or make those comments, really.
Well, if you think that you're alone in something, sometimes it's really funny that actually everyone has it. So, and we'll talk about Ireland, but maybe it's a good time to talk about Ireland. Ireland sent out a number of letters, and those specific insurance companies were like, oh, this is a bit of a worry. FiscalReps, what's going on? I've got a letter saying, do you want to make a voluntary disclosure? But we're compliant and everything's fine. Well, actually, the Irish sent that letter out, we think, to everyone. So it doesn't necessarily mean that you are being pinpointed. I'll talk about Germany. Germany, a couple of years back, was quite an active tax office and raised a number of audits and was very specific and precise with what they wanted to trace, that they wanted to actually hold the policy document and figure out how was that tax take actually taken. It's important to retain policy documents and your reasoning as to why particular apportionment was done and so on, which led to those taxes being declared.
Again, what we'd like to look at today is the different approaches taken by different tax authorities across Europe. And what we've noticed with the Germans just recently is that the tax authorities, and tax authorities being in its most general sense, are looking at policyholders, identifying the contracts of insurance that that policyholder has bought, identifying the amount of German IPT that is due on those particular policies, and then reporting that back to the IPT authorities, who then cross-reference to the tax ID to make sure that the correct amount of IPT is paid in the period that they should do. It's a very sophisticated way of determining whether insurance companies are compliant. It seems rather underhand, perhaps, to go and ask somebody else, but it's very effective. Another area that we've seen with the German tax authorities, and we make the comparison to someone like HMRC here in the UK. HMRC, when they've raised an assessment, is based on best judgment. They've looked at the situation, they've put together a report, they'll talk that through with the taxpayer, with the insurance company, and there'll be a sensible discussion as to whether or not there's a valid assessment to take place with the interest and penalty charges. The German tax authorities have taken a different view, whereby they will assess based on the legislation, and it's down to the taxpayer to prove otherwise, and therefore there can be quite a protracted negotiation discussion that would ordinarily take place elsewhere. Another aspect of the German tax, it's not German tax authority bashing here by the way, it's just what we've observed here really, and that is we have a large German insurance company who has many offices across Germany, and obviously they're paying a huge amount, a very significant amount of IPT to the German IPT authorities. And what's happened is the German IPT authorities have posted maybe 1, 2 or 3 individuals into those offices on a full-time basis. Now that causes a number of problems, very obvious problems, but one of those is that if a tax authority is entering into negotiation or dialogue with you over the phone or by a letter or whatever it may be, you can control that management flow. If the IPT authorities are in your office, they've only got to put their head around the door, and straight away they expect that information to be fed to them. And so it's a very time-consuming process that the taxpayer has to go through to be compliant with that particular office. And it can be a very inconvenient way as well, very unuseful use of that tax manager's time.
Spain is a territory we've marked as red. It's quite a complicated country to operate in. I'm going to leave Paul to talk through the trend analysis.
So effectively we have, in Spain, we've got Consorcio, who will carry out a trend analysis of premiums from one year to the next. So if they see a spike or a dip, effectively they want to know why, because it may be an under-declaration of surcharge, it may be an over-declaration of surcharge, and as such they want to know why. It's not a tax audit, taxpayer doesn't have to respond in any way, but if they don't, it could make life difficult later on. If, for example, that taxpayer, that insurance company, wants to make a reclaim of Consorcio surcharge, maybe the Consorcio won't be so willing to be cooperative.
Just to echo that actually, Hacienda, who collect the IPT from Madrid, also feel the same way. If they see a peak trough of declarations, that there isn't a consistent filing of taxes, this rings alarm bells for them, and they think, what is the finance department doing? Or, whoever is controlling the flow of recording of premium tax. Maybe the finance department haven't got it all under control and it's not being correctly calculated and declared in the correct period.
And this goes to how tax authorities conduct their audit. Because they don't have the resources they would like to have to audit every taxpayer in their community, they'll effectively develop a risk-based approach. And what does that mean essentially? Well, if you're a significant IPT payer in their particular country, they'll probably want to see you more often than not. If on previous audits you've shown to under-declare IPT or whatever parafiscal tax it may be, then again, you're going to be marked in that report as being non-compliant. And depending on that marking, they will they will audit more often than not. So there's very much a risk-based approach here. So really what the Consorcio are doing there is it's not so active as the IPT authorities in looking at the declarations. They're looking for those spikes in terms of how they basically price their surcharge for the next year. With regard to the Spanish IPT authorities, we've spoken over the last couple of forums about the provinces, which has been an emotive subject to say the least, and very sort of reluctant to bring it up here, but just to bring it to your attention essentially, that in the northeast part of Spain we've got 4 Basque provinces that are allowed to collect IPT directly from the insurance companies. FOS insurers until recently have been paying IPT directly to Madrid. The 4 Basque provinces have the power to collect the IPT based on 1980s legislation, and as such they want to enforce it. Now from an ongoing basis that's fine, because you can pay directly to each of those 4 provinces. The question mark arises over potential historic liabilities. My colleague and I, Nazaret Gonzalez, visited Pamplona, which is where the Navarra Hacienda are based, and essentially they said to us that they will want to go back and recover IPT that should have been paid to Navarra, and so applies to the other 3 provinces as well, in respect of the statutory time limits. Unfortunately, what they haven't said to us is the process to do so. It's going to cause a huge problem within the insurance community because there's no tax reporting that will identify location risk within a particular country. It can be carried out as a manual exercise, but it's going to be very time consuming, it's going to be very costly to the insurance company. So as such, we flagged this up as an area that could be potentially troublesome for insurance companies that write business into those northeast provinces. Simply because we don't know the rules. The tax authorities in those 4 provinces haven't articulated what that process is. They haven't shown any leadership, and it's great uncertainty and doubt as a result of that.
Moving over to Finland. Finland, we haven't necessarily seen a high incidence of audits. However, we have seen an incredibly tough approach on penalties. Insurance companies may come to us and say, I'd like to register with you and pay my taxes through you in Finland. However, by the way, I have already been operating there and I have some old taxes to pay. In that situation, we have found not necessarily the Finnish tax authority, but their computer to be very hard to handle. If the taxes and the penalties and interest aren't allocated by the computer to the first period, then the machine goes crazy and it starts calculating interest and penalties, sort of building up on the oldest, and you suddenly, one particular client had a bill for 30,000 euros, which was nonsense. We had a really long correspondence with the Finnish tax authority to get to the bottom of it, and in the end it was actually taken away and nothing came of it. However, in the meantime, that particular Austrian insurer was threatened with being named and shamed on a Finnish public list that tells everyone who the naughty insurance companies are. And the Finnish tax authority also nearly succeeded in going to the Austrian regulator and having that particular insurance company kicked out of Finland and unable to write business there. So that incident was actually in 2013, and this year we haven't had too many of those.
So we thought we'd call that a red country for that reason alone. Another red country is Greece, and maybe this is rather unfair actually, because the Greek IPT authorities would introduce an amnesty for a number of months over a number of years, and essentially what FOS insurers would do would be to save all their historic liabilities and pay them across during the amnesty period, knowing there would be no interest or penalty charges as such. That amnesty now has been withdrawn, which means that interest penalty charges are liable on those historic liabilities. Myself and my Greek colleague went to Athens last month to talk to the head of Indirect Tax, which is quite an achievement in its own right. It's taken 2 years to do that now. And basically what came through in that meeting is that the Greek IPT authorities are under-resourced. And this comes through time and time again with a lot of conversations with the different tax authorities. They would like to be more active. They know there's IPT that has been undeclared. They simply don't have the resources to go out there and do so. And in this particular country, it's overlooked. The head of Indirect Tax said to me, it's an overlooked IPT regime, it's an overlooked tax in Greece. That realization suggests that it may not be overlooked for so long, because there's a huge amount of IPT revenue to be generated for the Treasury. We know that Greece is in a very difficult position economically at the moment.
Italy, another red. Italy and GB have been the countries where our clients have had the highest incidence of audits this year in 2014. GB, I think we had 7 or 8 clients audited, and Italy, maybe 4. The contrast in approach between the United Kingdom and Italy is incredibly stark. The GB tax officer I would describe as quite sophisticated and has quite sophisticated techniques for identifying underpaid taxes. After we leave the map of Europe, we'll speed through to the questionnaire that our clients were faced with and the questions they had to answer. But in Italy, for the particular example that we have, the tax officer sort of arrived at our offices and said, right, I'm choosing these clients. I want to see all their books and records that are their authorization, the IPT book, the F24s and IPT returns for the following periods. I want them in 24 hours. It's fairly aggressive. So, 24 hours later, we furnished him with everything he needed, and pleased to say that our clients did fly through, but I think it's just to emphasize how important record keeping is in Italy.
In Italy, we're seeing desk-bound audits for the very reason around resources. And so what we're seeing here is that when the statutory time limits almost expire, a desk-bound audit will look to capture any potential IPT that may be lost in Italy. So it's going to look to reconcile documents available to the tax authorities. It's going to be the IPT book. It's going to be the payments on the F-24 for FOS insurance companies, and it's going to be the returns themselves. If there's any discrepancies in those three documents, the IPT authorities will hone in on that discrepancy, and that will trigger the audit and the whole series of dialogue between the insurance company and tax authorities.
It might be worth also bringing to your attention prepayment. You might think that there's no penalties to be had on prepayment. However, prepayment is not actually a payment of a tax, it's meant to be paying the tax in advance. There's an example that we can share of a client who has been penalised for not paying the correct amount of prepayment in advance. So quite an onerous and definitely a red.
Then if we go on to the green countries, we just want to bring to your attention to that's Austria and Belgium, just to let you know that they've adopted the same approach to the German tax authorities in terms of looking at the insured, the corporate insured, the risk managers. So they're looking at that, the same cross-referencing back to the IPT office. With regard to Amber, the Dutch Audit Office released a report just recently to say that the anticipated IPT revenue from the new IPT rate increase, so going back to 1st of January 2013, we saw the IPT rate increase significantly from 9.7% to 21%. An expected amount of revenue was due. The Dutch Tax Audit Office have found out that they're 70 million short, and as a result of that, it's anticipated now that we may see a number of audits in Holland that we've never seen before, simply because they're looking to make up the shortfall. That revenue is built into their budgets, and they're now in shortfall.
How much about that?
So essentially, what we've done here is to share our experiences with regard to the individual tax authorities, where you may see tax office activity, countries where you may not see tax office activity. Of course, it's a changing field all the time. What we'd like to do now, based on our last presentation, we'd like to skip the middle bit of it and go through to the questions. Simply because, as I was saying before, these are questions that the tax office have asked our clients over the last year or so. And I think what it demonstrates is an insight as to where the tax office is coming from. And really, as I was saying before, it's for you to think about internally as to whether or not you will particularly defend a robust audit. So the first question, is there a document such as a process map or a user manual that describes the way in which IPT is processed and managed in the business? If not, how do those involved in the IPT compliance process and decision-making chain know what is expected from them? When I was working for a bank in the city, I was a UK VAT manager, my duty was to produce procedure documents for every eventuality, from the VAT return to different income-generating areas within the partial exemption special method. It was there as a document that could be used by anybody coming into the business to do the job. What the IPT authorities is looking for something very similar to this. They're looking to see that there's a decision-making process that can satisfy them that the insurance company is being compliant in their particular country. I would also suggest that this question is a bear trap. If you answer it yes, then essentially you've got to produce those documents, and those documents need to be robust. If you answer no, then the tax authority wants to know how have you arrived at your decision-making process in paying IPT into my country, and that's a very difficult discussion to have with the tax authority. So that particular question, I think, is key, because insurance companies recognize that to be compliant from a corporate governance perspective, they need to introduce certain controls and put certain controls in place. I think the next two questions are pretty straightforward. Is there a designated staff member whose operational responsibility for IPT compliance? If yes, provide the name of the person and a summary of their responsibilities. So we'd expect the standard documentation to be in place. If you put a name forward to the tax authorities, expect the tax authorities to talk to that person. So you may need to brief them on their responsibilities and role beforehand, just to make sure that you're answering the questions correctly. The third question on the slide, who completes the IPT return and what is their position in the business? I think that's straightforward. And lastly, is IPT processing wholly or partly outsourced to a third party? If so, to whom? What IPT guidance provided to the service provider? And what assurance do you have that the IPT is processed correctly? So if you're outsourcing it to a third party, look at your service agreement to ensure what's the scope of work. With regard to our company as part of outsourcing services will provide a high-level review of data, we'll file and settle the taxes. What we can't do, if we don't have enough time, is to look at each policy documentation and advise you on what the IPT rate should be in each of those countries based on different type of products sold. So please be aware that even though you outsource that responsibility, you haven't, although I should say outsource the service, you haven't essentially outsourced that responsibility. That still lies with the insurance company, with the taxpayer.
Has IPT been covered as part of an external audit? Answering yes, again, mirroring what Paul said, they'll probably want to see the audit report. And when they see what the findings were of that audit report, if there is a management letter to do with IPT, they'll want to know that the weaknesses identified have been covered off. Does the annual external audit include IPT? Well, sometimes external audits don't actually drill down enough to IPT. Sometimes the external auditor just sees IPT as a transactional tax and, you know, what's the big deal? All you're doing is applying a rate. However, we've got a document that we affectionately called FRED. If you've been attending some of our forums before, you'll know there's a lot of different tax points across Europe, even for the very same class of business, different ways of apportioning, different ways of paying taxes, indeed those different taxes due. So it's not all that simple.
If you evidence an external audit report, be mindful of the findings. If those findings have made recommendations or they've identified weaknesses, then you want to demonstrate to the tax authorities that the insurance company has acted on those particular findings. The worst thing you can do is present an external audit and not follow it up on those action points, because again, that gives the wrong perception to the tax office.
When management decisions concerning IPT are made, how are those matters recorded and for how long are the records kept? The tax officer here is looking for a log of weaknesses or particular issues that have arisen, and also a solution. You know, what was done to overcome that particular shortfall. How long are the records kept? I guess that depends on the statute of limitation in each territory. GB, 4 years. How are tax risks identified, evaluated, and managed? Is there a register of business risks? So when an insurance company perhaps starts writing a new line of business, what's done at that point in time to make sure that all of the correct taxes are correctly applied? What controls have been implemented to mitigate any identified IPT risks? I think is mirroring the log, and I've probably already touched upon.
So the next question, I would suggest is another careful question to answer here. It doesn't look particularly menacing in any way, but what type classes of insurance have written, please provide the annual gross premiums for each line of business. In certain overseas jurisdictions, the IPT exemptions are linked to classes of business. Aviation liability, marine liability are good cases in point. And as such, if you're going to state the gross premium for an exempt type policy, the tax authorities can do some reverse engineering to determine how much IPT should have been paid. So again, when you're asked these questions, they may look fairly innocent, but there's a very clear purpose for asking those questions to try and find any potential underdeclaration of IPT.
Going to the particular 6 or 7 clients who were audited in the UK, on the particular questionnaire that my clients received, they were asked to list out against all of the 18 classes of business how much premium had been written. And for the tax officer, who was very nifty with a calculator, he could easily identify, well, that would have been a travel policy. Why is it a 6% across the whole board? So they're definitely looking quite closely.
Yes. Who determines the IPT treatment of each business line? And I guess this goes back to new products. If a new product goes onto market with the insurance company, what's that decision-making process in terms of determining the correct IPT amount there? It could be that it's an off-the-shelf product, it could be that it's a standardized product, but there needs to be some reasoning and thinking behind that you can demonstrate to the tax authorities. What is the name of the system used for processing premiums? IT systems are very important to the tax authorities. If you think of the number of transactions and the values that have been processed on those IT systems, tax authorities need the assurance that they've been processed correctly. And the type of areas they're looking at here are upgrades in software, whether data is stored. It's those type of things. What internal developments have been made to the software packages that could effectively misrepresent the IPT that's been paid across to the tax authorities. So with regard to these type of audits, it could be on occasions that IT specialists are called out to interrogate the systems on the IT systems and processes itself. What controls are used to check the accuracy and completeness of the reports produced from the underwriting system? Again, in my experience, there's sometimes a disconnect between the underwriters and the tax teams. The tax teams may know the answers to all the different questions with regard to IPT, but the underwriters may not. We've seen in the past that tax managers will post rate tables onto the internal intranet. It's then down to the underwriters to use the information correctly. They may not have any description, they may not have any guidance or help to get that right. So again, the tax officers are looking for procedure manuals and that type of thing. If you're part of a very large business and there are hundreds of underwriters, they're looking for training as well to ensure the underwriters know how to interpret maybe legislation or how to interpret what's on the internet system as well. There's also the issue here around hard coding. Some insurance companies hard code IPT rates onto their system, onto their underwriting system. So when a particular product is being sold, and if we take an example, let's say it's a sickness product in the UK, and it's travel related, the hard coding should show 20% IPT is due. If the underwriter has a facility to override that manually, the tax authorities want to know why. And if they can do so, they want to drill back into the history to determine how often it's happened, because the hard coding is there to protect the insurance company insofar as it's applying the correct IPT rate at the right time. So if there's any sort of manual overrides, that's where the tax authorities are looking for, because they're the inconsistencies that will be located during that particular audit. Next question, what IPT guidance provides to underwriters and other staff who take decisions on the IPT treatment of product lines? Already touched on that before. We're looking at coaching, training, we're looking to see, again, as an IPT officer for HMRC, I would actually look at the books that are in the bookcase with regard to IPT. Do you have the IPT legislation to hand? And if that's an Italian IPT audit or another overseas IPT audit, that's a tough question to have, because the chances are you may not have that documentation to support the decision-making process that you've gone through. What tax point methods are used, and is the same tax point used for all lines of business? Again, when you're looking at the very large insurance companies, their reporting systems, their underwriting systems will not be able to identify each and every tax point for each and every premium tax in Europe. We've located somewhere in the region of 95 premium taxes in Europe. That's the EU, Switzerland and Liechtenstein. We've identified in the region of 6 to 7 different tax points for those different premium taxes in Europe. And as such, it's very difficult for insurance companies to drill down to those different premium tax rules to ensure they're paying the tax at the right time. And as such, the business will take a commercial decision. They'll probably use one tax point. And in so doing, they've made the decision that if the money has been paid before the tax point, there's going to be a cash flow disadvantage. If the money is paid after the tax point, then potentially there could be interest and penalty charges for late payment. So that's something that the insurance companies and tax teams just need to be aware of there.
Taking Italy on that point in particular as well, Italy's cash received. If the tax is settled before the cash is received, also the Italian legislation says there will be no refund of IPT even when the premium is refunded to the policyholder. So that's another sort of disadvantage to not using CashPoint in
Yes.
Italy. Honing back in on the GB audits, the GB officer got to know those particular clients very well, and some of them were set up with broker networks where the cash, so GB has 2 tax points that you need to elect which one to use. Cash received for HMRC is cash received by the broker. So as soon as the cash is received into that sort of insurance system, that is the tax point. However, you can choose to elect the special accounting scheme if that cash takes a little while to trundle through until it hits the insurance company's books. So for a couple of those clients, an apology was made to HMRC and they elected to change their method from cash received to special accounting.
This is the last slide, by the way.
One of the questions are, this point is sort of matches up to what I was just saying just there. So what are the gross premium values sold direct, through brokers, through other intermediaries? And here the HMRC tax officer is trying to identify, actually, was it cash received or should you be on special accounting?
There's another aspect here as well, and it's looking to see what is a taxable premium. So you know what the rate is, you decide what the rate is, but what are you applying the rate to? What's a taxable premium? Is it gross written premium, net premium? Does it include commission? Does it not include commission? But most importantly, does it include third-party administration fees? In the UK, we're seeing very sophisticated legislation coming in to prevent anti-avoidance. It's also very complex legislation as well. When you cast your net across to other European countries, you'll find that some legislations will allow for third-party administration fees to be included in that taxable premium, and other legislations won't. And if you're using a large broker network and there's a large amount of third-party administration fees being charged, there could be quite a difference in terms of what you should be paying and what is actually paid as well. So that, especially in the UK, is a very key question to look at where you've got a broker network.
What IPT guidelines do you issue to brokers, intermediaries who take IPT decisions on your behalf? And that will be partly echoing that first bullet there, but also HMRC in particular, we're very keen to stress, well, actually the responsible party here is the insurance company. Just because you've outsourced this piece of the business to the brokers and intermediaries, it doesn't mean that you've washed your hands of it. They want to see that there are controls in place to ensure that the correct tax is taken and declared in the correct periods.
I worked on a number of due diligences many years ago, and this is one of the questions we had to ask the brokers and the insurance companies. So who set the rate? Who's responsible for the rate? In the event there's an under-declaration, what does your contract say? Is there an indemnity clause in place to protect one side or the other? So if you have a broker making decisions on your behalf, if an incorrect decision is being made, the chances are that if there's not an indemnity clause in place, it'll be the insurance company that will be basically footing up the bill for somebody else's decision.
What checks are done, I think we've covered that one. When policies are adjusted or cancelled, what are the procedures for processing the return premium and any IPT credits? We've touched on Italy. HMRC is a pretty neat, tidy legislation. There's certain limits for being able to reclaim on the return without having to make a disclosure. And here the officer is looking to make sure that those particular rules have been respected. Are any products of mixed IPT rates? If so, how is the premium apportioned between taxable and exempt risks? The particular HMRC officer that was looking at my clients was keen to get original policy documents and identify travel, look for any potential under-declarations there.
I think the UK is a very good example of that, because if you're selling certain products on a standalone basis, then it's likely that the 6% IPT rate will apply, or there's an exemption available. But as soon as it becomes part of a travel policy, then the whole characteristic of that product change from an IPT perspective, so it's going to be treated as 20%. And that's a theme that you can find with regard to certain European countries. And if you look at the exemptions available around marine liability, marine hull, aviation liability, aviation hull, how far do you extend that exemption? Will it be to any accident policies that are written in connection with that? Will it be related to any legal expenses cover with regard to that type of policy? So can you use that exemption, or do you have to break up that product and then apportion the premium between the different classes of business? So again, when you see mixed IPT rates, you see compound IPT rates, the tax authority, it just raises a sort of a red alarm bell in the tax authority's mind that something unusual is happening here in that respect. So we've concluded our insight, and we've actually finished before time, which we didn't think we would do. We've had to race through that. I hope it hasn't been onerous for you to go through our trip of Europe. If you have any questions as such, then please do ask them now, or if you want to grab us over lunch or during the break, then please do so as well.
Thank you
Thank you very
much.
much. Thank you.